Hello, everyone. I'm Ellis Frank. They call me the blockchain banking captain. I'm one of the producers of the Humanode podcast, founded by Carla Ballard, a global leader in the industry. Today, we're going to take a step back and then a step forward by looking at the history of investment banking, how it became the industry we know today, and why a quiet but meaningful shift is now unfolding beneath the surface. This shift is being driven by new technology, new regulation, and changing expectations around how capital should move. This conversation is especially important for middle market investment banks, the firms that sit closest to founders, family businesses, and real operating companies. This isn't about hype, it's about infrastructure, policy, and timing. Where investment banking began. At its core, investment banking has always been about connecting capital to opportunity. In the late 1800s and early 1900s, firms like J.P. Morgan and Company helped finance railroads, steel mills, and the physical backbone of the American economy. Deals were handwritten, settlement took weeks, and trust was deeply personal. Historian Ron Chernow captured this era well when he wrote that reputation was the capital that mattered most. After World War II, capital markets expanded rapidly. The rise of public equities, bonds, and later private capital reshaped the industry. Then came the first real technology inflection point in the 1970s and 1980s with electronic trading platforms like NASDAQ. By the 1990s and early 2000s, investment banks were operating with electronic order management systems, Bloomberg terminals, Swift messaging, clearing and settlement through DTCC. Complex Excel models layered on top of legacy systems. By 2010, investment banking had become digitally assisted, but not digitally native. What investment banking looks like today? Let's ground this in a few numbers. According to McKinsey, global investment banking revenues have hovered between $250 and $300 billion annually for much of the last decade. Middle market M&A alone accounts for roughly 30 to 40% of U.S. deal volume, yet those deals often come with thinner margins, longer timelines, and heavier manual processes. Behind the scenes, many banks still rely on multiple disconnected systems, manual reconciliation across legal, compliance, and finance, T+2 or longer settlement cycles, limited real-time visibility for issuers and investors. As one senior banker told the Financial Times, "We've digitized the front end of banking, but the plumbing is still decades old." What blockchain and tokenization actually change? This is where blockchain enters, not to replace investment banks, but to change the rails beneath them. Tokenization allows ownership, whether equity, debt, or fund interests, to be represented digitally on a shared ledger. That ledger updates in near real time, settles faster, and creates a single source of truth for ownership and compliance. The World Economic Forum estimates that 10% of global GDP could be tokenized by 2030. Meanwhile, the SEC has acknowledged that more than $3 to $4 billion in real-world assets are already tokenized in regulated environments today. Large institutions moved first. BlackRock launched a tokenized treasury fund. Franklin Templeton tokenized money market funds. J.P. Morgan built its Onyx blockchain settlement platform. But here's the key shift. This is no longer limited to bulge bracket banks. Policy and regulation are catching up. Regulatory momentum matters. The SEC's approval of spot Bitcoin and Ether ETFs signaled institutional acceptance of blockchain-based financial products. The passage of the Genius Act in 2025 clarified how stablecoins and tokenized value can operate within regulated frameworks. FINRA and the SEC have expanded guidance around digital securities, alternative trading systems, and custody. The takeaway is simple. Tokenized securities can now exist inside the regulatory perimeter, if done correctly. This isn't deregulation, it's modernization. Why this matters for middle-market investment banks. Middle-market banks are uniquely positioned for this transition. They already work directly with founders and owner-operators, operate primarily in private markets, structure bespoke transactions, serve as trusted advisors, not just execution platforms. Tokenization enhances this model by enabling faster capital formation, lower minimum investment sizes, broader, more global investor access, potential secondary liquidity through regulated ATS platforms. This doesn't replace traditional M&A or private placements. It adds another lane. A real-world example, BTIG. A useful example here is BTIG. BTIG is a mid-sized investment bank and broker-dealer that has taken a thoughtful, measured approach to digital assets and tokenization. Rather than positioning itself as a crypto firm, BTIG has expanded its digital asset coverage, research, and trading capabilities while remaining firmly rooted in traditional capital markets. BTIG has built institutional digital asset trading capabilities, developed research and advisory coverage around blockchain companies, engaged with tokenization infrastructure providers, begun advising clients on how digital securities and tokenized assets may fit into broader capital market strategies. What's notable is how incremental this has been. BTIG didn't pivot away from its core business. It layered new capabilities onto it, preparing for a future where digital securities coexist with traditional ones. Another example is Cantor Fitzgerald, which has publicly backed Securitize, one of the leading regulated tokenization platforms, signaling long-term institutional confidence in digital securities infrastructure. How long will this evolution take? This transition won't happen overnight. Most analysts expect 2025 to 2026, education, pilots, early advisory services, 2027 to 2028, broader issuer adoption and standardized tooling. By 2030, tokenization becomes a normal option alongside IPOs, private placements, and traditional M&A. The best time for investment banks to engage is before clients demand it, not after competitors have already launched. As Clayton Christensen taught in The Innovator's Dilemma, disruption is easiest to see in hindsight and hardest to respond to in real time. A recommendation for investment bank leadership. So what should leadership teams do now? Start by educating partners and senior management, engaging with regulated tokenization and custody providers, treating tokenization as an advisory capability, not a replacement business, piloting with one or two forward-thinking clients, building internal fluency before market pressure arrives. This isn't about becoming a crypto bank. It's about remaining a relevant capital intermediary. Closing thought. Investment banking has adapted through every major economic shift: railroads, industrialization, computers, the internet. Blockchain is simply the next chapter. For firms willing to approach it with discipline, regulation, and curiosity, it offers not disruption, but renewal. As the historian and scholar Ibn Khaldun wrote centuries ago, the form of civilization changes, but the need for trust and exchange remains eternal. Stay present, stay grateful. The future of capital formation is unfolding now, and there is still time to shape it. Thanks for joining our Human Node podcast on investment banking.